Welcome everybody to this public meeting for the Saskatchewan Auto Fund rate adjustment directed towards the motorcycle group. My name is Albert Johnston. I'm the chair of the Saskatchewan Rate Review Panel. For the information of those who might not know, the panel consists of 7 persons from across the province. They are Delane Barber, who is our vice chair from Weyburn, Dwayne Hayunga from Prince Albert, Glenn Duchak from Kenora, Kim Hartle from Lake Lenore, Bonnie Guillou from Saskatoon, and Keith Moen from Saskatoon. The panel is appointed by the government to review rate applications from 3 crowns: Sask Power, Sask Energy, and the Saskatchewan Auto Fund. Part of our mandate as a rate review, is to seek public input, which can include some form of public meeting. In the past, we have held meetings in person, but as technology has evolved, we have been using virtual meetings or a combination virtual and in person for some of our public meetings. The main advantage of a virtual meeting like this is that people from all over the province can participate without driving many miles, perhaps to Saskatoon or Regina. We have scheduled this particular meeting for the motorcycle groups, for concerned individuals related to motorcycle rates, for motorcycle businesses who have a heightened interest in this. We have seen significant interest in the motorcycle rates, and we have received in excess of 200 comments and notations via phone, via email, via feedback on our website, and posts on social media. In fact, about the only feedback we have received about the Auto Fund is from this group. Sorry. Well, there are some common themes and messages in the feedback. Sorry. While there are some common themes and messages in the feedback we have received, we believe it is important to hear directly from the groups and the individuals about their concerns over the proposed rate changes. Unfortunately, this is not a new message. In 2014, when the last rate application was in process, the panel received considerable feedback regarding motorcycle rates as they were proposed to increase substantially. Since that time, there has been some progress in terms of reduced accidents, injuries, and fatalities as a result of the programs that were initiated through SGI. And I'm sure SGI is going to be addressing some of this in their presentation. The format for tonight's meeting will be a presentation by SGI personnel regarding the background to the motorcycle rate process and the results that they ended up with in their rate proposal. Following the SGI presentation, we will hear from 2 of the motorcycle groups. Rage will be making a presentation, as well as the Saskatchewan Motorcycle Coalition, and we certainly look forward to hearing from these 2 groups. As an attendee at any time, you may post questions or comments using the Q&A section on your screen. If you wish to comment or pose a question, simply find the small icon near the top of the screen with the question mark in it. Click on it, and you should see a window that will appear and a spot where you can type your question. Our plan is to leave the questions and comments until the end, until the 3 presentations are over, and we will go through them at that time. But feel free to post them at any time. We would just ask that you keep your questions and your comments appropriate. Abusive language of any sort can't be tolerated in a meeting like this. So with that, I'll now turn it over to Jeff Steppen from SGI. Jeff is the Executive Vice President and Chief Financial Officer at SGI, and he will kick off their presentation and introduce the others that are going to speak. So with that, I'll turn it over to Jeff.
Okay, Thanks very much, Al. It's our pleasure to be here to present the findings of the rate adjustment that we're going to be going through for you now. As Al mentioned, I'm Jeff Steppen, Chief Financial Officer, and I'm going to be sharing the presentation duties with Chris McCullough, who is our corporate actuary. And also in the background, there's a few other SGI officials who will introduce themselves if they're called on to respond to a question. So for tonight's presentation, Chris is going to be talking about the rating process and the results for this application. And I'm going to be discussing the auto funds mandate. I'm going to review the financial results. And I'm also going to be talking about our capital and the level of our reserves. And just for the information for the motorcycle group, to ensure consistency in messaging, the presentation that you're going to see tonight is the same one that we're giving to the general meeting tomorrow night. Next slide, please, Chris. Thank you. So the mandate for the auto fund is to break even over time. So that is to collect enough revenue to cover claim and administrative expenses and to maintain adequate reserves. The other key mandate of the auto fund is to ensure fairness in rates, and that is to ensure that each class of vehicle is paying enough in premiums to cover their claims and expenses. Not too much, not too little. We don't want any subsidization going on with respect to rates. And very importantly, this is a public fund for motorists. The government has put no money into the auto fund, and it cannot take funds out of the auto fund. Next slide. So right now, the auto fund is collecting enough premium overall, hence the net 0% rate application. But individual vehicle classes are not all well aligned with their adequate rate. That's where you're going to see some vehicles are going to be increasing, some vehicles will be decreasing. They will all offset to get us to the 0% change overall. There are two components to the rates. The first component is an amount to cover claim costs and expenses. That's what we call the base rate. And the second part is an amount to ensure that the auto fund has sufficient capital in the rate stabilization reserve, and that we call the capital amount. Overall, claim costs have been increasing for the auto fund, so the base rate has to increase by 1.7% to offset those increased costs. And Chris is going to get into this in a lot more detail. However, on the capital side, we have sufficient capital in the rate stabilization reserve, so we can reduce the capital amount that is currently built into rates by 1.6%. And I'm going to speak to that in a few minutes. And when you compare the 1.7%, or combine rather, the 1.7% increase with the 1.6% decrease, and bring in some rounding overall, that's what gets us to the 0% rate change. Couple of key principles that the auto fund operates under. The basic insurance is being provided that's universal, and that means consistent, comprehensive coverage for all customers, and fair, and that means all customers are being treated the same. We also need to fairly rate vehicle classes based on how many at-fault claims the class has had in the past and how many we expect that they will have in the future, and how much we expect it will cost to deal with those claims. And the final point is we want to keep rates as low as possible. So the stated goal on the auto fund's balance scorecard is to be among the lowest two rates in all Canadian jurisdictions. Right now, we're the lowest. And given the operating philosophy that this is a public fund for motorists, there's little incentive to generate huge profits in the auto fund. The auto fund's coverage is defined in the Automobile Accident Insurance Act, and it covers three main things: personal injury benefits. Anyone who's injured in an auto accident will be taken care of. For customers who choose no fault coverage, that means lifetime income replacement, medical costs, physio, cardio, any kind of rehab coverage, medical devices, and home modifications. Tort coverage allows the party who's not at fault to sue the at-fault party in the accident for damages. And then also we have reduced no fault as an option exclusively for motorcycles, which we worked with the motorcycle group in the past to develop that product. Another level of coverage is the third-party liability, and that's the cover that covers the at-fault driver for the cost of injury or damage to others' property. And then, of course, the third part is repairing any physical damage to the vehicle, or if it's totaled, providing funds for the replacement vehicle. So given that background, I'm now going to jump into the financial overview to talk about how the Auto Fund has done over the last few years. So what we're showing here is the financial, very quick snapshot of the financial or the income statement for the Auto Fund over the last 5 years. The Auto Fund has a March year end, so these are for the fiscal year ended April 1st to March 31st. And you can see the net premiums earned over the last 5 years has stayed relatively flat, just over $900 million, starting in 2017 and increasing to $961 million in the last fiscal year. The next line down is total claims and expenses. So that includes our claim costs. It includes administrative expenses, our fees to issuers, and traffic safety expenses. And you can see that when you take the premiums earned less the claims and expenses, we're actually losing money, and that's what's called our underwriting loss. And that's on purpose. We purposely price to lose money on underwriting, knowing that we're going to have some investment income to offset that, and we have some other income like from our salvage sales. The reason that we have investment income is because we, when we receive the premiums from customers, we don't automatically pay those out in claims. We take them, we invest them, plus we have some reserves in the background, just in case we need a little bit more to supplement our claim costs. So you can see the investment income line and lots of variability in that line. And that's just the nature of the investment markets. As I said, the mandate for the Auto Fund is to break even over time, including a little bit of income to offset or to supplement the growth in the rate stabilization reserve. And you can see that in some years we make money, and for the 5 years we actually made money, made a little bit of money in some, made a lot of money in others. And in 2019-20 we actually lost money. So what we're looking to do is build up the rate stabilization reserve to a level that will allow us to draw on those reserves if we have a bad year, say for claim costs, or a bad year for investment markets like we did in 2019-20. The pandemic caused a crash in the investment markets, and as a result, we had to dip into the rate stabilization reserve to cover that. So we didn't have to go to customers and ask for more rate. We just use the rate stabilization reserve as a buffer. So I'm going to talk a little bit more about that rate stabilization reserve in a few slides here. So you can see that we had a outstanding year in 2021, and that allowed us to do a few things. We were able to make a few enhancements to injury benefits for our most seriously injured customers. For the living assistance benefits, that meant increasing the maximum weekly benefit for things such as dressing, bathing, cooking, cleaning, and yard care. We were also able to increase income replacement benefits. So the standard practice in the industry is to reduce the amount of a person's benefit by any amounts that they receive from Canada Pension Plan. We stopped doing that reduction and giving those customers the amount of their Canada Pension Plan, which ultimately resulted in higher income replacement benefits for our most seriously injured customers. So in addition to the improved injury benefits, the Auto Fund was able to rebate $285 million back to all customers, which amounts to about 26% of the average annual base insurance premium paid by each customer in the last 3 years. So on the next slide, we're looking at here why the Auto Fund requires a 0.6% capital margin. So I talked a little bit about the need for a rate stabilization reserve. In addition to protecting customers from sudden large rate increases, it also ensures that the Auto Fund can meet its claim obligations. As noted, in some cases, we're taking care of injured customers for the rest of their lives. So we're looking out potentially 50 years or more, and lots can change in that time. So we need to make sure we have an adequate buffer in case those reserve estimates are off. So if you go back to 2014, and I'm going to show you this in a few slides, we didn't have enough in the rate stabilization reserve. So 2.2% was added to rates to slowly build up capital. And now that we have enough in the rate stabilization reserve, we can again reduce that capital amount. The question might be, why don't we reduce that to zero? And if you look at the next slide, talk a little bit about our capital management policy. So SGI doesn't just get to decide how much capital stays or how much money stays in the rate stabilization reserve. There are industry standards and models that are used to calculate and determine how much capital would be appropriate to hold. The insurance industry uses a measure called the minimum capital test, which calculates the level of capital that's being held by looking at the riskiness of the liabilities, and the more risky your liabilities, the greater the level of capital that's needed to be held. Looks at the riskiness of the assets backing the liabilities, and if you have safer assets like bonds backing the liabilities, the lower level of capital that's required. So the Auto Fund's current target is an MCT of 140. Now the number doesn't mean anything other than I'm going to show you a slide in a bit to explain what that 140 means. As defined in our capital management policy, there's two parts to the capital margin that gets built into rates. We have a maintenance amount, and even though premiums haven't been increasing much, the Auto Fund's liabilities continue to grow as new customers, unfortunately, are being added to claims, and the old customers aren't necessarily dropping off. So as our liabilities grow, so does the reserve, and the buffer needed to back those liabilities has to grow. And we also have a second part of the capital amount, and that's a capital build or release. And this is the amount that's designed to move the rate stabilization reserve closer to target, either up or down over time. So what we're looking at now is that we have more capital than we need. So we're reducing rates by 2.9% to cover that, but we need rates to increase by 3.4% to ensure that the Auto Fund's capital is increasing enough to cover off the anticipated growth in the business. So the 3.4% growth minus the 2.9% release plus some rounding is what gets us to the 0.6%. Now, to just take it one step further, we have 2.2% in rates right now. We only need 0.6, so we can reduce rates for this capital amount by 1.6%. The last slide that I'm going to show is the available capital. So what this shows is the level of capital based on the minimum capital test calculation relative to our current target of 140. So you can see back in 2005, 6, 7, we were in very much the same position that we are in now, in that we have just a little bit more capital than we need. but you can see how quickly that changes. In 2008, we had the investment market crash that pulled our capital level down. Happened again in 2011 when markets crashed again. And then if you look in 2014, we were sitting at just over a 60% MCT. We needed to increase rates to build our capital back up slowly. We didn't do it all at once. And with that, in 2014, with that change, we slowly built our capital up. So to the point where we're at now, at the end of 2021, we're sitting with more capital than we need. And as a result, we can reduce the rates and essentially eliminate a big chunk of that capital build that was built into rates. So I'm going to pause there. I'm going to turn it over to Chris, and he's going to talk about the rating process and the results of the analysis. Over to you, Chris.
All right, thank you, Jeff. So as the actuary for the auto fund, my main role is to measure how much the auto fund needs to charge to expect to break even for the rating year. So there's three major components to the rate application: making sure that we have an adequate amount of premium overall to break even. Number two, fairness in rating. That's digging in a bit to individual vehicles, making sure each one is charged a fair rate for its individual risk. And finally, maintaining adequate capital, which Jeff has spoken to quite a bit here. So I'll be focusing in on these first 2 points and our work as part of the rate program. So the overall indicated rate change that Jeff mentioned was an increase of 1.7%. That's what's needed to break even, excluding the whole capital management consideration there. So because what's driving this factor are overall improving injury claims experience, which actually helps to reduce how much premium is needed in the auto fund, but offset by rising overall damage costs and increases to the expenses. So if it was only for these components, we would be increasing by 1.7%, but with the removal of the capital margin component that Jeff explained, that's how it results in an overall revenue neutral proposition. So digging in a bit on what it means when we say we're seeing improving overall injury claims experience. I'm going to be speaking here on an overall basis. Down to individual classes of vehicles, the experience can and does vary, and I'll be covering that a bit later, specifically thinking about motorcycles here. But at an aggregate level, back in the 2014 rate application, we had trends on the kind of the left of all these numbers shown here for different types of injury benefits. We had medical, income replacement, and death benefits rising year over year by 4% or more, with care benefits or living assistance staying flat over time. Now, in this current rate application, it's completely turned around. Income replacement benefits and death benefits, the cost of those are decreasing each year by over 4%. Medical benefits have become flat, and care benefits have started to decrease as well. Now, there's a variety of factors this can be attributed to. There's a number of traffic safety initiatives the Auto Fund has put into place since 2014. There's also a bit more enforcement of impaired driving, as well as some additional laws along that. And finally, every year, there are more and better safety features included in vehicles that are sold. The most important thing is that this means fewer people injured or dying in car crashes every year in Saskatchewan, which is an amazing impact on their lives and the lives of their families. In terms of the Auto Fund, it translates to reduced costs, which also translates to reduced premiums needed to cover those costs. Offsetting those injury reduced costs is worsening damage claims experience. So the main driver of this is rising repair costs, mainly due to the complexity of the technology that's now present in cars, the procedures needed to repair them, and the materials that are associated with it. Those same safety features that are partially driving the reductions we're seeing in the injuries are a lot more expensive to repair. For example, a minor fender bender, which may have only damaged a bumper and triggered a replacement, now with a lot of sensors and additional technology on those bumpers, is a far more complex repair. So comparing to repairs from 5 to 6 years ago, we see a much higher cost for those same types of repairs. Looking here at the overall collision severity or average amount paid per crash for private passenger vehicles, what used to cost less than $4,000 on average is now costing over $5,000, which is well over the level of inflation over this period and remarkably consistent over time. As those costs rise, so too do the premium or the rates that need to be charged by the Auto Fund to offset them. I also want to speak to the effect that the COVID-19 pandemic has had since its effects began in March 2020, we have seen noticeably fewer claims being reported over that time period, but not in a uniform or even way. When there were periods of significant restrictions in place, we saw noticeably fewer claims. But as those restrictions relaxed, the number of claims rose back up toward a normal level. That effect is fading now over time, and we expect claims to return back to an approximately normal level by 2022, the rating year that we're looking at as part of this rate application. The one exception here are commercial vehicle classes, which may take longer to recover from the economic impact of the pandemic. And so as a result, in this rate program, we've assumed a reduced volume of vehicles of 5%, which affects both the premium and claims from those groups that we're expecting in the rating year. So far, I've been speaking kind of at a very high level at the overall rate indication work, answering that question of how much premium is really needed to offset the claims and expenses we expect to see in the auto fund. The next question, or the second point from the beginning, is how do we take that and determine individual vehicle rates from it? And it's no small feat in the auto fund. There's over 30 classes of vehicles, each with their own assortment of vehicles with different rates. And different vehicle classes rates depend on the specific vehicle characteristics of that class. Buses, for example, we've seen that the number of the seats on the bus correlate to how much it costs to repair those claims or how severe those claims can get. The variable like number of seats makes sense for buses, but may make no sense at all to use for motorcycles, where we've seen other variables, such as the engine size of the motorcycle, correlate highly to the severity of injuries that tend to be seen for the riders. We also don't want to change individual vehicle rates too much in a single year, which is why we have a rate capping process in effect. So this rate capping schedule is proposed for the current rate program. And what it means is for most vehicles, we expect a maximum of 15% increase or decrease to the current rates. And that's for vehicles whose current premium is over $1,000. Other vehicles with lower premiums will have a dollar cap, according to this chart, depending on their current annual rate. Right now, in the auto fund, only 21% of vehicles' rates are close to their adequate level, or that level needed for their risk. That's the effect of not having an application since 2014. With the proposed rate changes and capping as part of this current application, we expect to move 93% of vehicles to be close to their adequate rate. I'm going to highlight a few of the vehicle classes that will still be potentially far from paying the adequate level of premium. We can see here motorcycles, motorhomes, and taxis all have 70% or more of the vehicle rates still not at that adequate level, even after this currently proposed rate program. Personal trailers will have just over 40% still not there. And to contrast that, the largest group in the auto fund, private passenger vehicles, will pretty much be there. Over 95% of those vehicles will be close enough to their adequate rate, within 5% is our measure for that. So digging in on some individual vehicle classes to talk about the indications and changes since the last rate application. Motorcycles first, of course, the focus for tonight. Motorcycles require, as part of our calculation, a 34% rate increase to break even from between their premiums versus their claims and expenses. After the effect of the capping schedule that I listed there, that rate increase is expected to be 10%. That means for individual motorcycles, is 88% of them increasing and 12% of them decreasing in rates. Motorcycles needed over 70% rate increase back in 2012. And since that time, that rate need has been brought down through a series of rate increases, as well as the initiatives were put in place in 2015. Additionally, since the last rate program, and that new option has been put in place where motorcycle riders can elect a reduced level of no-fault coverage in exchange for a discount applied to the rates they're charged. As part of this rate program, we have no change to those discounts proposed. And on top of that, we are refining the engine size and model year grouping categories so that the rate charged for a specific motorcycle better reflects that specific motorcycle's risk profile. What we've seen in the history for motorcycles is generally claims exceeding the premium. This graph shows the premium, the line, versus the claims being in these blue bars. And I'll note even that this chart doesn't even include expenses. So in order for the group to break even, we would need those insurance premiums line to be regularly above the claim costs. But we can see in the history, there's been some years where it's fallen very short as well. You can notice that recently in 2016 and 2017, the group is very close to breaking even. But since that time, the premium has been declining at the same time as claim costs have been growing, which gives rise to the current rate need that we have here today. We have seen success with the other measures and initiatives put forward for motorcycles, but we're at a point now where we believe that raising rates needs to be at least part of the solution to aligning premiums with the claims and expenses for the class. On to another group, permits. They're very short-term registration options, generally either 24-hour or 8-day permit time periods. And this is the first time an actuarial indication has been done for permits in the auto fund. Their rates haven't changed in over 20 years. These increases we have here proposed are to align the premium with the claims risk we've seen on permits in history. 24-hour permits are to rise from $20 to $26, and 8-day permits are to increase from $48 to $73. The next group I'll speak to are taxis. Taxis have an indicated 38% rate increase required, and after capping, that effect will be 13%. Unfortunately, a rate need is not new for the taxi group. They've required 30 to 40% back in each of the 2012 to 2014 rate programs, and the effective capping has meant that it has never gotten all the way there. Back in 2013, SGI worked with taxi companies and other stakeholders on a review of the business recognition program, and a number of changes came out of that program to help address issues that those stakeholders rose. For example, the discount was increased from 10 to 15%, the maximum surcharge was reduced down to 25%, and there were some changes to make it a more even playing field between individuals and companies who are in the program, which was a specific request of some taxi stakeholders. A new group in the auto fund since the last rate application are transportation network companies. So due to their unique nature, rideshare companies needed a different rating structure. So they're rated based on the number of kilometers driven because of how different usage can look between different rideshare vehicles. One of them might operate every day of the week and have a risk profile very similar to a taxi, whereas another may only operate one evening a week and have a much reduced risk profile. The rate we've initially set up for transportation network companies is 11 cents per kilometer, applied only when the vehicle is participating in ride sharing. And that's not proposed to change in this application. This was initially determined using the adequate taxi rates, which is higher than what they're currently paying because of their current rate need. If we were using a rate that aligned with the current taxi rates, this initial rate would have been closer to about 8 cents per kilometer. Another group with a significant rate need in the auto fund are motorhomes. They require a 135% overall increase in rate. After the effective capping, that's going to be a 20% rate increase proposed. Now, this rate need has been building every year since 2014. There has been a strong growth in rodent infestation claims and the cost of cleaning up for those claims. There's a lot of concern over the viruses carried by these rodents, and it's not a problem that's unique to our province either. I haven't really mentioned our largest group, private passenger vehicles, so I'll kind of end on them. The rate for a specific vehicle, a specific private passenger vehicle, depends on the experience we've seen for claims in Saskatchewan, but also by insurers across Canada, as we may not have enough claims experience on a specific vehicle in our province alone. Private passenger vehicles as a whole are getting an average around 1% rate decrease, but the key is that that rate change is going to vary for each vehicle inside the class. I have some examples of some popular Saskatchewan vehicles on the screen here. The 2010 Dodge Grand Caravan, the 2008 Honda Civic, and the 2007 Toyota Camry are examples of rates that are decreasing, in some cases pretty significantly, whereas the 2018 Chevrolet Silverado and 2018 Ford F-150 are seeing increases. Other vehicles may have a small or almost no rate change needed. The PDF on our website will show the rate change proposed for each make, model, and model year of vehicle, so you can look up your own specific one there as well. Finally, I'll cover one last slide looking at a comparison here. As Jeff mentioned, one of SGI's operating philosophies was to keep rates as low as possible. And with this rate program, we are proposing no change to that rate level. Comparing to our history of rate changes to the CPI measure of inflation, we can see that since 1999, overall CPI has risen by in excess of 50%, where at the same time, the auto fund's cumulative rate changes overall have been an increase of 7%. That's one measure of how, in the aggregate, we are trying to keep rates as affordable as possible for Saskatchewan residents. So I hope this sheds some light on the reasons for the rate changes that are proposed right now and included in the application before the panel today. Thank you.
It's Don Fuller from the RAGE organization, and we're going to go through our presentation. What we're going to talk about first is some of the short-sightedness from SGI when the only tool you have in your toolbox is a hammer. Everything looks like a nail, and this seems to be a bit of a historical move. What you're going to see from us this evening is the effect of SGI's failure to recognize critical elements in both internal and external that affect the policies and the fiscal solvency of the auto fund. SGI has failed consistently with repetitive behavior, like with the 09 to 24 rate increases, one after the other, and premiums still not covering costs. Now, this is happens when you only have one tool in your toolbox. What's missing is a complete view of SGI's market and customer and complete inclusive data sets such as the socioeconomic impacts of 2014 from 2004, and of course SGI's biggest competitor, which they don't even recognize. What SGI is missing in this rate proposal doesn't consider is the socioeconomic impact from 2004 to 2014, which was the oil boom, which brought about serious social problems in Saskatchewan. We had a highly transient population boom, very high disposable income, very young, 20 to 30-year-old demographic, earning between $100,000 and $200,000 in the oil patch for all those years. And it was kind of like Wild West in Saskatchewan during that time. And it brought around some permanent reactions from SGI to what was really actually a temporary problem. With what else was missing with 2004 to 14, SGI removed motorcycles from the larger risk-sharing pool. And that meant that a tiny, tiny demographic must now stand on its own instead of being in the larger collective and risk-sharing. But also at this time, the traffic collisions and accidents and injuries from 04 on were escalating all over the province, not just in motorcycles, 0-8s, deaths, injuries, right across the province. And it was a huge problem, not just motorcycles, but they were one of the few that was removed from the greater risk pool. Part of the issue that we see is SGI fails to see its clients as a customer base, and the fact is they are a customer base. And as a customer base, they have two kinds of spending in their wallet. One is utility essentials, and the other is discretionary, and the utility being your house, your transportation, groceries, clothing, things like that. And discretionary is non-essentials, like a boat, motorcycle, alcohol, tobacco, restaurants, entertainment, things of this nature. And what's happened now with rates for motorcycles being what they are, the cost has outstripped most household wallets. People just can't afford it. And in a nice to have world, these are the things that soon get put aside. So if we look at the 2013 rate proposal, there was a whopping proposal of 73 to 300% increase. And at that time, the motorcycle community pushed back, and there was about 5,500 members that came to our group in about a 5 to 10 day period. It was just an outrage. And what happened at that time, of course, is Premier Wall came out and issued a public apology, stopped the rate action, and established the Motorcycle Review Committee, because there's got to be more than just rates involved. So what happened with that rate proposal is SGI was forced to go back and have another look. And it was maybe beyond just an actuarial table. The 73 to 300% rate proposal was reduced to 34%. And what happened with that, with the motorcycle review committee set up, we found that there was no learner's license requirements for motorcycles. People could go and take a little 5-minute computer test, never having had a driver's license, and were allowed to drive and ride motorcycles on the streets and roads of Saskatchewan. There was no restricted protective clothing. You could ride around in a bathing suit as long as you had a helmet on. And you could do this for the rest of your life. You never actually had to take a road test. Now, there's a small wonder that accidents and injuries were starting to escalate. And at the same time, SGI had improperly been administering the auto fund policy for at fault, which led to lopsided accounting. That means that in a 2-vehicle accident, where one was a motorcycle, all of the costs for that accident were laid on the motorcycle side of the auto fund. And that put a lopsided slant on the requirement for premiums for motorcycles. That was the whole at fault loss transfer problem that was going on at SGI. And they admit there was a $9.2 million error due to that wrong rationale for the rate proposal in 2011. Remember, the only thing you're looking at is rates, and there's much more than that in behind it. So if your only tool is a hammer. What we learned from the rate hearings in 2012 is that approximately 54% of the motorcycle owners plated year-round, leaving about 46% for partial plating, still a long-term revenue stream. And SGI identified at that time, if year-round motorcycle owners opted for only 5 months policies, the premiums would be reduced by 24%, $4 million. That's a huge drop in revenue. And that would leave with a projected premium revenue of only approximately $13 million. That's a $9.2 million error in SGI's assumptions for premium shortfall between 2011 and 2013 due to loss transfer. Key learnings from the rate hearings in 2013. We understand that motorcycle premiums loss was reduced from 9.8 to 5.9 million in 2011. That's a 40% reduction. For 2012 included in this application, the reduction has been from 866,000 to 550. That's a 36% reduction. When it was pointed out to SGI by RAGE that the at-fault costs of the policy were being administered incorrectly, the correction of this issue was appropriately signed, and all of the costs, injury and accident, were signed to the at-fault vehicle. That's a big, huge change. That alone brought about a $300 reduction in the requirement for annual motorcycle insurance premiums. Again, that's not looking at the rate tables. So now we'll come to the review committee, the recommendations and implementations that came about from that. And we brought about regulation and license changes, a 3-year graduated learning program, safety changes such as protective clothing, hours of operation, which were right out of whack until we got in there. Zero alcohol. We also increased revenue from the SDR. And that meant that high-risk drivers needed to pay higher penalties for a longer duration and a greater discount for safe drivers. And that was actually an attempt to stop the cross-subsidization that you folks are always talking about between the greater risk pool and the motorcycle community. So the SDR didn't get it entirely implemented, but a great deal of it did, and we got a bit of a discount for safe driving, and the rates did go up, the penalty rates, and the duration went up, and that proved to be quite a revenue stream. But we haven't seen any of that in any of the results so far. Now, we also noted that after all of these pieces were put in place, we gave SGI approximately 7 years, because that's a decent amount of time for the actuaries to be able to determine the effect of these changes that they implemented at the recommendation of the Motorcycle Review Committee. And you can see that the at fault has dropped well below 50%. And for the 2013 rate hearing, they were saying that the motorcycles were at fault well over 50% of the time. And again, that's it just wasn't a correct assumption. Now, these charts are right from SGI. You can see that since we implemented these changes, that collisions are now down 27%, injuries are down approximately the same, with an average of 50% reduction in a decade. This has nothing to do with leaning on the rate wheel. This is just doing things that should have been done in the first place. And that resulted in a surplus in premiums by 2015. Now, injury costs came down. They were on an average 117,000 per injury. They're down to 90,000. And SGI admits themselves that these reductions are more than likely due to safety improvements among motorcyclists, nothing to do with leaning on the rate wheel. And again, there is no question that the motorcycle review undertaken in 2013 and its recommendations in 2014 were a complete success. If that's the case, then what's happened? What's changed? Why are we sitting here again 7 years later and the motorcycle side of the auto fund approaching insolvency? Well, the fact is, premiums for revenues from motorcycles is down 39%. And that's because of the cost. You've priced yourselves right out of the pocketbook, and people are reaching out for the low-cost alternative. Also, something that was not within our control at all is the investment side had dropped to 42%. And that's a huge drop, meaning that the reserve was no longer solvent. But wait, now the rate stabilization reserve is $1.1 billion. That's after a $285 million in rebates, and you're still at the table asking for more money again. Something's wrong with this picture. And you can see from this slide, and these are SGI's slide, that there is continued pressure being put on from rates. Registrations are down, long-term revenue is down. You can see where these numbers are going. And SGI admitted that any rate increase is likely to reduce further registrations and cause these numbers to drop even farther, which is going to push the motorcycle side of the auto fund further towards insolvency. There's just no way to get around it. You've priced yourself right out of the market. And here's what's happening. Here's the low-cost alternative sitting on the table. And these are your numbers again. People are going to permits. They're starting to license instead of the long-term buying habits that they had previously. They're now starting to permit according to the weatherman. If it's a nice weekend, they'll take a short permit. If they're out off for a week, maybe they'll take a longer one, but they're not registering. And your long-term revenue stream has just dried right up. The registrations aren't down, and people aren't really riding less. They're just discriminating instead of leaving their plates on for 4 months, 6 months, and many for a year. So that revenue stream for you is in peril, and you know it. It doesn't sound like a big increase, 10%. It almost sounds reasonable until you understand that we have the highest rates in Canada for motorcycle licensing, the highest rates in North America, in and around $3,000 $1,000 a year, and a 10% increase on top of that is going to just push that migration to permits even farther. Your revenue stream is going to take an even further dive, and if continued, you're going to push into insolvency. So the motorcycle review is a success. Long-term safety, hours, licensing, these things were all working, not leaning on the rate wheel. And injury and accidents were down, and it's all very positive. You guys have never had results like this in any program that you've set up before. Yes, there is a slight uptick in 2019. Although you yourselves have stated in the past year, the number of collisions has continued to rise, and it's too early to know if that's a one-year anomaly or a sustained trend. And once again, you folks are trying to put in a permanent solution to a very temporary problem. And it's going to push the whole motorcycle side of the auto fund just into the red. And if you don't return to a rate, that'll encourage the community to register long-term to 4, 6 months and many for a year and just leave them languish over the winter time, that you're going to be in trouble. Even using the 2011-12 rate projections from the rate review indicated a surplus for the auto fund. If you see this board here, premiums, even if they just stayed at 2012 and enabled historical customer purchasing to continue in the same manner, that the results from the review committee, along with this continued trend in purchasing, would lead to a mostly solvent motorcycle fund. And that's just if you use 2012 rates. That's not even considering moderate increases. So the solution is, if you could get back to around the 2012 premiums, which earned 13.4 million, and that would encourage people to long-term license again. The unique registration numbers are quite static. They haven't changed on an average of 27,000 a year. Then if you go to a return to a reasonable rate, a potential long-term positive revenue stream, and you're going to continue to focus on traffic safety and do the same good work we've been doing up until now, there's no need for the motorcycle class to have a rate increase of anything. The projected results, of course, are long-term solvency for the auto fund, and we're after the same thing that you are. But the truth is, if you continue to just lean on the rate wheel, leading Saskatchewan to have the highest rates in Canada and North America, with this 10% increase, that's your fast track to insolvency. And everybody knows it. And that's it for us.
Okay. I want to thank Rhonda and Don for their presentation. Some pretty thought-provoking comments for the panel to take back and consider. And we unfortunately can't promise anything, but we are certainly going to look at the slide presentation, and we may be back in touch with you to clarify some issues that you've brought forward. So thank you again, and hope you enjoy the rest of the meeting. Okay, are there questions and comments in the Q&A section that we could go to now? Go ahead, Chris, if you want to answer that.
Yeah, sure. I'll handle that first question. Now there's two I want to clarify. So it's the can provide studies that shows a bigger engine size equals worst injuries. So the use of engine size as a rating variable for motorcycles is a very common one across Canada. In fact, the Insurance Bureau of Canada publishes some statistics and some variables to be used that could be used by insurance companies all across Canada. And that is a standardized variable that is used by them. So while I can't point to a specific study, we do have a significant amount of data in our own auto fund experience displaying that strong relationship between engine size and total cost of injuries. And it's a popular enough variable that it is used by insurers all across Canada as part of their motorcycle rating.
Any other questions there that we can put up?
Yeah, there is one other published there.
Okay. I guess this is a pretty general question. Does SGI concur with Rage's numbers? And there was a lot of numbers up there. Some of them were your own numbers, so you probably concur with them. But I guess I don't know if there's anything specific you'd like to address, Jeff.
Sure, and I think well, Chris, you've probably got some thoughts. There were a number of things that were said that were, I guess, inconsistent with the way we see things, and I think overall, would be happy to sit down with Rage and work through, and with the panel to work through some of the numbers. The comments that that we took motorcycles out of the larger pool. Motorcycles were their own rating group for as long as we have been doing rate indications. So, again, there's a number of things where there's some inconsistencies from the way that we see things. So rather than just sort of going through a list, I think best just to maybe have another conversation with Rage and work through these. Chris, have you got any other thoughts?
No, I was about to say something very similar. I think that covers it.
Have you met with Rage in the past?
Yeah, we have.
Okay.
Yeah, as part of the consultations, we met with Rage.
Okay.
There is another one under published, Al.
Yeah. Okay. This is a question from Gilbert. It says, "Can you provide such data that you said?" And I assume that relates to the engine size. If that is the case, why other companies take in consideration size, makes, and model, driver's age, and even credit scores, but SGI doesn't?
Yeah, I can jump in to provide a response on this one here.
Yeah.
We absolutely do have that data, and we could provide it. There's a number of different ways it could be covered. This could be an idea for a potential information request from the rate review panel as one aspect to make it public, or we could make it public through another method on our website as well. So in terms of other companies, we do have a much simpler, I would say, overall rating model as compared to a lot of competitive companies, which do focus on trying to get the most granular variables possible for rating. Including, as you mentioned, age, credit scores. A lot of those things are covered through other things that the Auto Fund does, like the Safe Driver Recognition Program, which serves to rate based on the person registering the motorcycle based on their own personal driving history.
Okay. Any other questions or comments that people would like to make? Okay, well, I don't know if we need to hang on any longer. Oh, one more here, just as I was about to cut it off. The question is, are the demographics for motorcycle purchasers changing? Chris, do you have data on that at all?
I can toss out that I'm not entirely sure on that one, and I'll call it out to the panel here to see if anyone has any other insights on this response.
That might be something that we could speak to the motorcycle dealers about. But yeah, we don't not necessarily new, and it's I guess we could look at brand new motorcycles, but when used motorcycles are purchased, we can't monitor the age. So that wouldn't be data that we have readily at our fingertips, but maybe there's other ways we can get at it, or through some other Statistics Canada, etc. has things like that.
Okay, thank you. Gilbert says, I have, again, I don't know if this is the same Gilbert, but he says, I do have a lot of questions. Have you ever considered to have a separate SDR for motorcycles and other vehicles. Since you are separating the auto fund from cars to motorcycles, why not separate the SDR as well? Is that something you've looked at as part of that program?
So the Safe Driver Recognition Program is a pretty comprehensive program that's, very complex. I actually was involved when we first introduced it back in 2001, I believe it was. And it took us 3 years to develop, to get all the rules right, to actually come up with the concept of how we reward, how we penalize for good driving, and to incent good driving. So it took a long time to do the concept, and then it took at least 2 years to build. You have to imagine that every single transaction, and there's millions of transactions that go through the auto fund each year, impact that rating. So there's just a lot of detail in the system. So to do something completely separate for motorcycles hasn't been contemplated, but we are embarking on getting a new system for the auto fund, which we do hope will be more flexible to things of this nature. So I won't say never, but right now with the system we have, that would be a pretty complex undertaking. But we'll keep an open mind on how things could go once we get a more flexible system, for sure.
Yeah, as a panel member, I would say that there's a balance between punishing drivers who are unsafe, either demonstrated through by accident or traffic tickets, and penalizing those versus incenting people to have a good driving record and giving them the benefit of that. I've driven for a goodly number of years, maybe more than I would care to remember. And I've never really had an at-fault accident except when I was about 20 years old. And so I've paid insurance all these years to fund somebody else's accidents. But that's what you buy insurance for, of course. And I do have the advantage of the safe driving discount. So it's a balance, and I know that some of the comments we received on our website and so on think maybe that balance isn't quite right for motorcycle drivers, but it's hard to say when you don't have the numbers in front of you. So. Okay, any more questions out there? Well, I don't see any more questions popping up here, so I guess maybe I'll just say in closing, I want to again thank the presenters from SGI for being here and presenting the essential elements of the auto fund proposal. And I also particularly want to thank Rage for bringing their presentation forward. And as I said, there's a lot of good thought-provoking comments in there, and we will be looking at it. Of course, we can only make recommendations. We can't enforce any change in policy or so on, but we will be looking at the recommendations that might come through in consultation with our consultants. And we take all of these comments that we receive through our website, through emails and telephone messaging and so on, and they will go into our report. I would encourage any of the attendees as well to follow this on our website. They can keep track of the questions that have been asked. I believe they either have been posted on our website or will be very shortly. So you can go through there and get a bit more information. I would also point out that the deadline for public input into this process ends, I believe, August 29th. So we would encourage you, if you have more comments or concerns, to address them either, again, through comments on our website or an email or whatever. So I appreciate that information coming forward to us.
We did
Jeff
have one
or
more
Chris?
question come in now.
Oh, okay. Oh, good question. How were the permit fees determined?
Yeah, I can definitely handle that one there. So the fees we're proposing for permits as part of this rate application uses the same logic as we do for the other classes of vehicles through studying their claims history. The only difference is, of course, being registered for much shorter periods of time when we compare the amount collected versus the claims. So it's entirely based on that same logic of trying to align each of the groups for the 24 hours, 8-day permits, etc., to be expected that their premiums will cover those claims and expenses that we've seen for them. And of course, in future years, we'll continue monitoring them and adjust those rates as needed in future rate programs as well.
Okay. Okay, well, seeing no more at this point, I think I will declare the meeting ended. And again, I appreciate everybody's participation. So we'll, and SGI and maybe some of the other people on here will see you back again tomorrow night.
Thanks, Al.
Okay, thank you.
Bye-bye.
So.